as I see it, there's two big headwinds here. You have a distracted CEO, and then you have very real policy concerns when it comes to the big, beautiful bill. You write recently that the big, beautiful bill might be too much for Tesla shares. Tell us why.
Thanks, Katie. By the way, first off, you're catching me at the end of vacation, so I feel inferior looking at Dan Ives' jacket.
You look
I'll
great.
have to upgrade my wardrobe. So, listen, I think you've got two things going on. As you guys said in the previous segment, there's not a lot of focus on the core auto side of the business, even though it is the vast majority. And I think we have previously talked about the focus on robotaxi and humanoid robots and see these longer term opportunities. What has changed, though, is while the $7,500 tax credit was well known, telegraphed, probably in the market already, the regulatory CAFE fine reduction was not. And that is about $2.8 billion of profits for Tesla. So what investors are going to have to do is they're going to have to hold their nose and stomach more margin hits and a reset of street models, in our opinion, lower to accommodate sort of getting to that promised land of these newer opportunities like robotaxi or humanoid robots, et cetera. And we think that that's just too difficult with a 1-2 punch between the $7,500 tax credit and the CAFE or the basically taking those EV credits to zero.
Jed, let me first say that I, too, am a big fan of Tommy Bahama. And secondly, ask how much of this, trillion-dollar company is the car business? I mean, do you look at that way? Because as we talk about all the time, the valuation is just insane for a car maker or almost any other company on the planet. So how much of the car business matters?
Yeah, so let me frame it in terms of shares, just so that viewers might be able to get a better handle. I think, if you took a look at a, back of the envelope, sort of sum of the parts, using a 10 times EV to sales on just the auto business gets you about $40 to $50 per share. On the energy business, probably another $30 per share. And so that means the remaining value would be on these other robotaxi, robots, potential for value in terms of dojo, et cetera. All of that non-auto side. So, I think let me maybe jump to what the next logical question would be. So if the auto business goes from a 50 to a 40, not a big move in terms of the shares, but it's going to test the patience, in our opinion, of investors, because you won't see robotaxi really scale and kick in by our estimates until 28.
Yeah, and you can see that patience being tested this morning with shares down 6.7% pre-market. I don't actually think we've talked about Dan Ives' wardrobe enough, so let's actually take a listen to what he had to say on Bloomberg TV earlier this morning.
I believe you've now hit a point. I think the board's going to have to get involved because this is now over. I think there's a line in the sand that he's now starting to cross. And that's the frustration. As someone that's a huge supporter of Tesla, autonomous, the golden age ahead, you cannot kind of go down this path.
I thought that was interesting, Jed, to bring the board into this. Do you share that opinion?
I don't. And the reason being is, Elon has supermajority voting rights of Tesla. Your shares, it's not like we're talking about the shares being $100 per share. I mean, it's $294 per share. So, despite, what seems like a lot of pressure recently in terms of off of the high, you're still at 3 times where your low has been. So I just don't see, the board coming. And it's also, with Elon, it's a little bit of a double-edged sword where, I would argue what people are paying for is his ability to innovate. Elon Musk is one of the great innovators of our modern day. So taking him out, does the board really, would they really want that? And I think, when you kind of ask that difficult question, I just don't see them stepping in at this stage. But I'm not privy to that right now. But I would not share that opinion.
What do you think are the problems here with a sell rating? Only 13 analysts of 61 have had the, I guess, courage to go there, because shorting this stock has been a fool's errand, right? I mean, ask Jim Chanos, and he'll just tell you about the times he's been burned, and he's not willing to do it again.
I mean, I've been around this stock for, about 15 years. And yeah, you're right. I mean, it is, I wish I had $1 for everybody that would tell me that it was a great short. And it has not worked out that way. That being said, we need to focus on the fundamentals. And I think the fundamentals associated with this bill definitely take some of the luster off this right now. And for our clients, we'd rather wait for a better opportunity to get more bullish, or to see, I think we're kind of in an in-between where the signals aren't as great right now, but, there wasn't enough for us to defend it either.
Well, when it comes to the fundamentals, policy headwinds aside, what does the demand picture look like when you think about the American appetite for EVs right now?
Well, it's going to get worse. I mean, actually, near term, it's going to get better, because your expiration of the $7,500 is going to expire at the end of Q3. So we actually suspect that there will be a boost in the very near term in terms of demand. However, as that rolls off, the vehicles are either going to get more expensive, or the margins are going to get worse. So, as we look out, say, 2 years, 3 years, really until you get robotaxi that comes on and the data points to suggest the scaling of that, it's going to be, it's going to be noisy in terms of the signals versus noise.